Hello and welcome to MF Corner. I'm Sonal Bhutra, and with me as always is Vinni Motiwala. And today we have with us Nirav R Karkera, the head of research at Fisdom, to answer all your MF queries. And we've received a lot of them through SMS, through Twitter, through social media and emails as well. So let's get going and get to our first query. Nirav, thank you so much for joining us today and taking our time to answer all the queries that we have received. So let's get started with the first one, because Devi is writing to us from Bengaluru. She's a long-term investor and wants to invest around 1 crore rupees for the next 5 years. She wants to know if mutual funds or alternative investment funds or AIFs offered by different fund houses are the better options. Nirav, it's a specific amount, a crore over 5 years. What do you suggest? Should our viewer invest in mutual funds or AIFs or diversify between the two?
So I feel first and foremost it is important to understand the distinction between two, right? So of course everyone knows about mutual funds, but AIFs focus on very specific niche mandates, right? They try and offer propositions to access alpha from opportunities that mutual funds are often than not able to capitalize upon, at least not in its entirety, right? So AIFs are a great proposition to look at. However, one important caveat here is that the minimum ticket size for AIFs are 1 crore. All right. Now, considering that the investor has only 1 crore to invest, if she were to go the AIF route, right, she would have to invest in a single strategy that would lead to a lot of concentration. So most AIFs are also considered to be slightly higher on the risk pyramid versus mutual funds. So too much, concentration into one strategy that is inherently riskier does not make for a sound portfolio. It makes sense for people with a larger portfolio who just want to manage their diversification through the AIF route. However, in this case, considering that the total investable amount is 1 crore, I feel a very, very effective job can be done through mutual funds itself. In fact, a more strategic approach of dividing the portfolio into core and satellite portfolios should hold the investor in very good stead. The core portfolio, of course, a larger portion of the portfolio could comprise of well-diversified funds belonging to flexi-cap, multi-cap, and such more flexible mandated fund categories. Some of the funds that we like in these and which could serve as a good starting point for the investor could include the likes of DSP FlexiCap, 361 Focused Fund, Kotak Multicap Fund, and a few of these other flexible mandate funds. And for the satellite portion, where we expect the risk to be inherently higher and exhibit higher volatility, but the potential for outperformance over a longer period is significantly high, this can comprise of your satellite portfolio. Here you can start delving into mid caps, small caps, and sectoral thematic plays. That is, if you are willing to actively manage the portfolio. So a good starting point would be to look at funds like an Edelweiss mid cap, a Bandhan small cap fund, or perhaps even an Invesco India contra fund if you're willing to go the strategic thematic route. So a diversified composition of such mutual funds that are strategically allocated towards for longer term return generation should hold you in much better stead than putting all your eggs in one basket that AIFs are.
Right, Nirav, that's an interesting one there. But, let's move on to the next query. Afternoon, Nirav. We have this query coming in from Lakshmi, who is writing to us from New Delhi. Now, she says that she is investing via SIPs and shares like L&T, Infosys, HDFC Bank, ICICI Bank, the top 100 ETF, as well as Motilal Oswal Nasdaq top 100 ETF is what she's investing through. So she says that she wants to replace her SIPs in L&T, Infosys, ICICI Bank with BEL, Coforge and KIMS. How should they be going about this?
So one good thing that's working really well for Lakshmi is that she's ensured that it's a very high quality blue chip portfolio. In fact, a very, very smart move to use a mix of mutual funds and stock as well. In fact, some of the names mentioned are marquee with a very strong track record of delivering consistent performance over longer periods. So this is going superbly fine for Lakshmi. However, with the entire concept of replacement, right? So I'm assuming there are two types of replacements that Lakshmi would be wanting to check out. So one is replacing the current holdings, the existing holdings with the new set of stocks that she's spoken about. So, in such a case, you need to be very conscious of two things. One is, of course, there's going to be an immediate tax incidence, and which may or may not be warranted if capital gains are accrued. And second, the more preferred approach is to replace subsequent SIPs with some of these names. Now, here, the biggest caveat is I'm presuming that all the homework, research, rigor has been exercised while arriving at these three stocks, because they belong to categories much beyond the blue chip category, right? So, of course, if you very strongly believe in it, you may continue to allocate incremental money towards these stocks. However, one must be very conscious of the fact that these are just three stocks that you spoke about, and you must be wary of the fact that as you move away from the blue chip, of course, the potential to generate great returns is also very high, but the probability of going wrong, or rather the margin of safety, is also very thin, right? And the probability of going wrong is higher. So you need to be very, very sure about these three bets. Of course, the portfolio is large cap oriented. There is a clear case for mid and small cap exposures to come in as a portfolio approach, but it is definitely warranted to also take the fund route to manage these exposures, because some of these stock names that you have presented, they are very thinly covered, at least versus the blue chip companies, and there's very little research that's available in public domain, secondary research, if that's what you're banking on. Right. So unless it is your primary research, you may want to take the fund route to increase your mid and small cap exposure. If you yourself are a professional or an experienced investor, and try and ensure that the subsequent SIPs are diverted in this direction. The core portfolio looks pretty solid with the names that you already have.
Okay, take that point. Looking largely beyond the large cap base of that's the query coming in from Lakshmi. Nirav, let's talk about the next one. Anand is writing to us from Telangana and wants to know the mutual funds that are good for an aggressive investor. Wants specific names that you can help with.
So aggressive investors, I'm assuming if you're aggressive, you will also have a longer time horizon. Please understand there is a thin line between being aggressive and being reckless. So the idea is not to completely overload on small cap, micro cap sort of funds. The idea is to still be risk conscious while participating in the higher degree of volatility. So starting universe could use some very, very good focused mandates that are market cap agnostic, that are very focused on bottom up style of stock picking. Some of the names that come to my mind immediately are 361 Focused Fund. On the mid cap segment, yield wise mid cap fund has been doing phenomenally well. It has been showing a lot of promise going ahead as well. If you take a slightly thematic approach, Invesco India Contra Fund is a very, very good starting point. In the small cap segment, of course, you're an aggressive investor. Some small cap exposure is warranted. Bandhan Small Cap Fund is a very good fund to look at. Now, these are some of the actively managed funds that you can use as starting points. But apart from this, there are a few passive propositions also that you can use. It is it's not as conventional as an idea to use passive funds. But trust me, with the way the industry has evolved, there are some really good propositions that one can take. For example, factor-based propositions like DSP Nifty Small Cap 250 Quality 50 Index Fund, Edelweiss Nifty 100 Quality 30 Index Fund, UTI Nifty Mid Cap Quality 50 Index Fund. These are some very, very good index funds which are factor based and which will try and extract and optimize for quality even in the more riskier segments of mid cap and small cap. If you are an avid investor and you can actively manage your portfolio, you can definitely look at adding sectoral or thematic funds depending on what point in the cycle are you willing to invest and how actively are you willing to rebalance and manage the portfolio even going forward.
Some of these interesting names coming in there, but do keep an eye out on those disclosures, given that you are an aggressive investor, so where you should look to invest in. But on that note, we're going to actually sip into a very short break. Don't go anywhere. We'll be back with more of your mutual fund related queries after the break. Welcome back to MF Corner on CNBC TV18. Today we are solving all those mutual fund queries that you all have sent us. And we have Nirav to solve all those doubts. Nirav, we have this next query also which is related to small cap funds only. Sachin is writing to us from New Delhi and he wants to know the best small cap fund to invest in for 10 years. You did mention Bandhan Small Cap Fund. So any other names that should come in, and should it just be one of these or in a couple of names that they could look to invest?
So I feel that's something, most investors are looking for. Anyone with a 10-year horizon wants to look for a good small cap fund. So at Fisdom, whenever we do our mutual fund ratings exercise, we try and prioritize for the ability to generate long-term, consistent, sustainable performance, even going ahead, basis quant qualitative factors, right? So of course, I spoke about Bandhan Small Cap Fund, but there are two more funds that come to my mind that have incredible promise to perform really well over the longer period. It includes Edelweiss Small Cap Fund as well as Invesco India Small Cap Fund. Now, to your question, whether it should be just one of this, considering the distinct styles in which these three funds are approaching small caps and the reasonably lower overlap, it would be a smarter way to allocate in at least 2 to 3 different funds. Of course, it makes sense only if the portfolio overlap is very less, but when you're entering the small cap segment, bottom-up skills are highly requisite, and it really distinguishes one fund management strategy from another. So pick 2 to 3 funds with distinct investing styles, distinct philosophies, and less overlap.
Okay, so less overlap and a larger term horizon or longer term horizon, sorry, when it comes to investing in small caps as well. Let's go to the next query now. Manthan Shah is writing to us from Rajasthan, has currently invested equal amounts in large, mid and small cap ones. He wants to know, Nirav, if he can increase exposure equally, or should he go about investing in one segment more and keep changing that ratio over a period of time? What do you have to say?
So right now, equal weighted is a good way to go about it. The way we look at valuations, the house view is that large caps right now offer a relatively good margin of safety. It is not deviating a whole lot from longer term averages. So large cap offers some good cushion. However, when you move towards mid caps, it is trading at a premium from a valuation standpoint, and small caps, for that matter, is trading at quite an elevated premium, even higher than that of mid caps. But having said that, these are aggregate commentaries on the entire basket. We strongly maintain that mid caps and small caps shouldn't be viewed at basket levels. They are not really homogeneous or as analogous set as large caps are, right? So there are still pockets of opportunities. If you have the ability to actively manage your market cap exposures and from a pure valuation perspective, it would make sense to increase your tilt towards large caps for now. And if you have to increase mid and small caps, you must be highly selective in the strategy or the stock that you are willing to back and put your money into to manage your small and mid cap allocations. If you are unable to do that on your own and you want to optimize at a market cap level, tilting towards large cap should hold you in good stead.
Okay, Nirav, this next query has come from Shankar, who's writing to us from Chennai. He says that he's planning to start investing in mutual funds and bonds, both through small lump sum amounts as well as SIPs. But however, there's a possibility that he may actually travel and move to the US, most likely. Now, he's read that NRIs, especially those in the US, have some taxations on mutual funds that can be significantly high due to FATCA. Would it be more prudent for him to actually focus only on direct stocks and bonds instead of mutual funds? What's your advice?
So right now, as long as you're in India, of course, mutual funds and bonds are the most cost-efficient, tax-efficient investing routes that you have. However, if you wish to go abroad and the plan is really concrete, you may want to start setting up outbound investments that are dollar denominated. Right. So the Gift City option opens up a plethora of options for you to invest outbound in dollar denominated securities. That's one thing you must explore. In fact, if you were to move to the US and also still wish to continue investing in India with much more favorable tax terms, there are also inbound Gift City propositions that will help you do it more effectively. So Gift City becomes a very, very important aspect in your scheme of things. Please keep an eye out for the propositions that are available through various products, and several of these products also finally feed into Indian managed strategies, right? So Gift City becomes important here. Apart from that, of course, due to the FATCA norms, there could be a slight edge or benefit to maintain a direct stock portfolio, but however, it comes with a whole lot of other risks of individual stock selection that may or may not be worth the cost of saving taxes, right? So Gift City managed products are your best bet at this point in time.
Okay, all right. So that's about NRI investing and certain aspects of that when we invest in mutual funds and stocks. Let's get to the next one. Mani Kaku has been investing 50,000 per month for last 2 years. Wants to generate a corpus of 3 crores over the next 7 years. He has moderate risk appetite and wants to know the monthly amount in terms of SIP which was required to achieve this goal, and if he should be going ahead and reviewing his portfolio as well. Nirav, what's your take here? Is this number okay? Do we have to be a little conservative when we talk about returns for the markets over the next few years?
Absolutely, Sonal. Like you rightly said, I'm just going to pick it from there. We can pencil in as many projections as we want, but we know that the longer term average has been close to the 11, 12%. So even if you take a conservative 10% CAGR, hey, and conservative is important because you don't want to be caught off guard at the end of your long-term horizon, right? It's good to be conservative today than to regret tomorrow. So the current 50,000 may not really suffice. That is because the target is so high. At a 10% CAGR growth expectation, and of course, you would want to adjust for inflation at roughly around 6%, you would need to maintain an average SIP that's almost 6x higher than what you're already doing, in around the ranges of 3 lakh to 3 lakh 25,000 per month. However, having said that, one scope of relief that I'd like to give you is you need not do it immediately. You can aggressively top up your SIPs and step up your SIPs because you have a long runway ahead. So as and when your income rises, and if you're really, really focused on this goal, please prioritize on stepping up. It should make up for any shortfalls that you have been having up to now. So you still have a good winning shot at this portfolio, right? So that's important. Also, on the screen, there were a couple of funds that have been presented as a part of your portfolio. A quick review and few observations. The portfolio is clearly tilted towards large caps. And in fact, it's not just large caps that's the problem. It is the overlap between these funds. Like there is Nippon India Next Nifty 50. There's IPRU large cap. There's Aditya Birla Flexi Cap, right? If you look at these and in pairs, for instance, the Nifty Next 50 with the large cap has an almost 60% overlap, right? The Next 50 index with the ABSL Flexi Cap has an almost 50% overlap. And the case goes similar to, of course, large cap and Flexi Cap because it's a part of the same 3 large cap portfolio. So the overlaps are really high. You may want to simplify the structure, have just one passive large cap fund for cost efficiency, right? There's no incremental value that you're deriving. Instead of choosing another active fund with very high overlap, what you could instead do is increase mid and small cap exposures to create longer term wealth creation. Of course, through the course of this conversation, I've spoken about a few funds that we really like in the segment. Use that as a starting point, but instead of adding more and more large caps, considering you have a long investment horizon, try and up your mid and small cap exposure. So Edelweiss mid cap fund, Bandhan small cap fund, I've spoken about it. Good starting points. Dig around these fund mandates, and you'll be good to go.
Okay, keep an eye out on that. Couple of names that Nirav has mentioned through the conversation, but also, overlap is a big concern that comes in always as well. But Nirav, thank you so much today for joining us and helping us solve all those mutual fund related queries. And with that, we're going to wind down this edition of MF Corner on CNBC TV 18. It's a goodbye from Sonal, myself, as well as the team who put this show together. But don't go anywhere. You have the last hour of trade that is still left, and closing bell is up next for that.